as a day trader, I'm wrong several times a day. And if I don't admit that, I'll get in real big trouble. So we have to be very honest about our mistakes, very honest that we didn't have the right read, very honest we didn't have the right management in place. And that certainly helps. The other one is detachment. Every religious tradition teaches detachment. And we need to be detached from our own projections that we usually put upon the chart. We can have that bullish feeling about the market, about a chart, about a stock, a company, and we start looking into the chart and reading things that aren't actually there. We have to let the chart speak to us. So we have to be detached from those preconceptions.
Yeah, absolutely. And just real quick, because I did find it very interesting. You touched on it a little bit, but what was your dissertation on? Because I just found it fascinating.
Yeah, so I was writing on a couple of German philosophers, and their their discipline was the theory or the philosophy of interpretation.
Hmm.
And it might seem like kind of a simple thing. How do we actually derive meaning from a text, which is something other than myself? It's speaking to me from an ancient source in many cases. And I have to somehow get what the writer intended to mean into my head so I understand not only what he meant, but how it applies to my own wisdom, my own thinking, my own life. And that's quite a process. So philosophers have a lot to say about that process. And to a large degree, really, the key to interpretation is to hold back, as I said, your preconceptions and allow the text or the stock chart to speak for itself.
Hmm.
What about because sometimes when two different people are looking at a stock chart, they may actually end up seeing different things, maybe from actionable, kind of action points, or maybe because they're looking at different time frames, or
Time
their
frame.
entries are different, right?
Right.
Talk a little bit about that. I mean, even in your trading room or the people that you're mentoring, do you
Mhm.
run across that?
I do all the time.
Okay.
I post 20 or 30 stock charts a day over on
Hmm.
StockTwits and Twitter and the Facebook posts and LinkedIn and so on. And I always have, for the most part, I have a read on that chart, and I'll draw the trend lines, and I'll usually draw some arrows where I think it should be going, might be going, ought to be going, based on what I'm seeing in the chart. And invariably, there will be half a dozen folks who respond in the annotations that I don't see it that way.
Yeah.
And for the most part, it's a distinction that needs to be made between my read of the chart and their read of the company. There are a lot of
Yeah.
Tesla bears out there, for example, but
Right.
the chart itself is often in a bullish pose. So those perma bears on Tesla are always going to argue with me about my reading on the chart if I think it's bullish. But they're coming at it from a totally different angle. And that's fine. We just have to be clear where we're coming from and the framework that we're working within. A lot of times, too, as you suggested, Irusha, that it's a difference of the time frame.
Right.
I
Hmm.
might be looking at an hourly chart. They're looking at a weekly chart. We have
Yep.
very different readings. Yeah.
Or it could be, the time frame of your horizon. If you're
Right.
looking at something and you're like, oh, I'm just looking for a quick swing trade, you're seeing a setup that looks pretty good as opposed
Yeah.
to, oh, I'm looking for something that is, more long term. Well, then you might need a little bit more evidence before you got involved in something because
Yeah.
your
No,
risks.
exactly right.
Hmm.
Exactly right. Yeah. The time frame, the length of the trade that you expect to hold on, that how high your profit target is, how tight your stop is, all of those things will go a long way toward determining whether you're overall bullish or bearish.
Hmm. And so why trends? What got you started with the whole idea of trend following? Because, again, a lot of the stuff that you've written, that you founded, the trend, that seems to be one of the main key components of what you're
Mhm.
doing. So why trend following? What got you into that?
Well, that's a great question. And I think the simple answer is that the very first trading course I took was on trading the trend.
Hmm.
And it was the very first trading discipline I learned.
Hmm.
Now, unfortunately, I'm sad to say, that the fellow who taught that course ended up going to prison for some fraud allegations. So I can't
So hopefully
recommend
he
his
didn't
course.
teach you that part.
No, he didn't. No, he didn't. But I did learn a couple of really important keys. And one is that there are some very easy standard ways of determining the overall trend of the stock. You've got your longer term moving averages, which give you the long term trend. Your midterm moving averages, midterm, short term gives you the short term trend. And when you see these moving averages flipping on top of each other all the time, you know that you're in a transitional phase.
Mm-hmm.
So, I always have these 5 categories of trend: strong trend, weak trend, trading range. Strong uptrend, weak uptrend, strong downtrend, weak downtrend, and then a trading range. And you can determine which of those 5 market conditions you're in simply by looking at the 20, the 50, and the 200 period moving averages. Now, I've gotten a little bit beyond that. I use some other tools. I'll show you one here in just a minute.
Mm-hmm.
But yeah, knowing the trend is really one of the 2 keys to determining market direction.
Mm-hmm.
Got to know the trend. And then secondly, you've got to know whether you're near, at, or just about to encounter a top or a bottom.
Right.
I know it's not always possible to call the top or the bottom, but we do need to know whether we are at or near a major pivot point in the market. And there are
how
a
do you
lot
know
of tools. Sorry?
And how do you know that?
Very, very good question. So
The $1 million
calling tops
question,
and bottoms
right?
are a little different. There's a different tool set required for each one. Now, calling a top is maybe a little more difficult because markets do tend to just slowly keep hitting new highs, new highs, new highs. Everything gets more and more overbought, and market never really reaches that extreme threshold at the top end, as it often does at the bottom end, because fear is just a lot stronger for most of us, an emotional response than greed at the top. But if you just put a trend line underneath the pivot lows in an uptrend and start marking where that trend line gets touched and then marking again where it breaks, you know you're at a market top of some kind. And a second thing that you can do is start looking at the volume bars down below. And this is something I learned from William O'Neill. And that is that if you mark the big red bars as distribution days and the big green bars as accumulation days, you can tell whether the trend still has some legs or whether people are starting to get out. We saw this right at the beginning of 2022, right? This year, there was a lot of distribution and there was a break of trend. We saw it again in 2007, just before the big 2008 crash. Same thing happened. Break of trend, lots of distribution before and after that took place. So that's the top. For the bottom, you've got all kinds of interesting tools. So I have a whole set that I always consult whenever we're in a prolonged downtrend like we are now. One of them is, for example, the NASDAQ summation index put together by McClellan. And there are certain numbers that when that hits below negative 800, we're almost always at a near-term pivot. And when it's below negative 1,000, which it has been this week, we're at or near a major pivot. We saw that this week. The last time we saw that below negative 1,000 was in December of 2018. December 24th, Christmas Eve, was the very bottom.
The Christmas Eve massacre.
The Christmas Eve massacre.
Yeah.
And we were out buying like crazy that day. I mean, I should say not like crazy, because it's always a fearful thing to step back into a major pullback like that.
Right.
But everything else was flagging extreme. And the other time we saw below 1,000 was at the bottom in the COVID bottom, and again in 2009, beginning of the end of the financial crash. So that's a good tool. I always keep an eye on the VIX, especially when we're volatile like we are now. When it gets stretched up above the upper Bollinger Band, that's usually a signal that we're due pretty quick snapback sometime soon. Market breadth, market internals, keeping an eye on highs and lows, bullish percents. Those are the sorts of markers that can give you readings at the extreme. And when you start seeing a whole collection of those add up, you know you're at, close, or near, if not right at, a market bottom, major market bottom. That's kind of where we're at right now, I have to say.
Mm-hmm.
So,
well, it's interesting that you say that, because we were just talking with Charles Harris last week on our
Right.
podcast about these secondary indicators. And so, you know, in a way, this kind of like sets up the stage for, okay, you're near a bottom, but what tells you that the bottom has put in? Do you just start buying when those indicators get to those oversold levels, or what is it that gives you your final, okay, now it's not, maybe not safe isn't the right word, but safer?
Right. No, that's a great question, and there's a very good and easy answer to that. Let me just first mention that another indicator that is not regularly consulted, but which just gave an extreme reading that I've never seen before, that is the amount of retail participation in the market. It's at a low that people that have been keeping those numbers, and I don't know who it is, and I don't know how long they've been keeping the numbers, but it just hit the lowest low ever.
Wow.
The number of people, retail investors, retail traders, who are just not in the market anymore.
So, I mean, that's a pretty big switch, because earlier this year, and really the first few months of this year, the retail was buying these dips, right?
Yeah. And that dropped very, very fast. So there's a number of anomalies in this market that kind of make your head scratch a little bit, you know, like we're still seeing strong job numbers. We're not seeing huge spikes in jobless claims. Consumer sentiment is still really high. Credit ratings are still healthy. So there's still, you know, there's some disconnects there. But to get back to your question, Justin, there's a very simple pattern. I teach this to my clients all the time, that when you're at a major market bottom, you want to look for something in price, and it's very simple. You want to see a higher pivot low, and then you want to see a run that takes out the most recent pivot high. So it's kind of I don't know what the shape of that is, but a little bit of a cup and handle down there at the bottom.
On what time frame are you looking at, though? Is there a specific time frame?
Yeah, well, this would be all on the daily chart, of course. If you're looking at sort of, you know, okay, now that whole pullback is behind us. Now let's look ahead to the new bull market, which we're not there yet, but it's coming fairly soon. But you can do the same thing on hourly charts. You can do it on 15-minute charts, on 2-minute charts, looking for that, you know, long pullback, and then you get the higher pivot low that then takes out the most recent pivot high, and that 90% of the time is going to mark a pretty good significant pivot in the market.
And when you get one of those pivots, one of those signals, do you have an expectation of how long it lasts, how powerful it will be, or is that just something you have to see play out?
Yeah, I don't have any kind of statistics on that. It's a good question, but typically in my kind of halfway educated estimation, it takes a lot longer for the market to go up than it does to go down. It tends to go down with the elevator, go up by the stairs.
Right.
And so if the pullback, the bear market correction is 8 months long, then I think we can at least double that for the bull run that succeeds it.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.